again, as we've discussed 100 times on the show, there are a million reasons to be cautious and concerned about the market at the moment. But one very good reason, I think, to own the market is, I have to say, a lot of our viewers are pondering, well, what else would I own at the moment? Do I really want to go into government debt? Do I really want to go into private markets? Do I really want to sit on cash on the sidelines? And then when you put it that way, it doesn't seem as bad a bet to have some exposure to companies that are run way better than governments in many ways.
I think that's a great point. Good morning to both of you.
Good morning.
Market open. You're right. I do not want to own government debt, especially at the long end of the curve. I think that much is evident. I think with the amount of fiscal pressures and fiscal spending that we're going to see across the board, I don't see that long-term debt as an asset class is attractive any longer, really, at this moment. So what's the option? Bet on innovation, bet on companies that are run better than sovereigns, for sure. And by the way, if you remember last time you and I met, I said that I owed you something positive to say about Europe, which I came prepared today to say that.
Wow, thank you.
No problem. It's little, but it's okay.
Well, go on then, I'm ready.
European
rolling the red carpet out for your positive comment on Europe.
Lo and behold, European families that own these great institutions for multi-generations are built for resilience, which is what is needed in a market like this. And they are run better, they are governed better, much better than the European Union and the bureaucracy that kind of governs Europe. So I think even buying a piece of that story within Europe, as negative I am as normally as Europe, I think is not a bad bet. Just as I was saying that, I came across a piece of news that said, well, you know, Europe is going to levy taxes for companies that have more than 50 million euros of a turnover. Wrong move. So betting on innovation, high growth markets, I think is the way to go, Steve.
Interesting, you've put two different ideas out there, betting on high growth innovation companies. You've also said investing in companies that have solid family, multi-generational ownership. Right. Those are very different thematics as well. Of those big family-owned companies, and I tend to be directed towards France and Italy on those kind of companies. Italy is full of these amazing companies where the family have held for many generations, you know, the Iannelli kind of investments and what have you. But they aren't tending to be the high growth companies. So does any area of the European market tick that box, multi-generational ownership, and the high growth area?
Look, I don't think you can or you should have both. It's ultimately about balancing your portfolio.
Okay.
One end of the spectrum, high growth innovation, and you know my views on that. I am long the US market when it comes to that, just because capital chases innovation and risk capital and liquidity is available plenty in US. When it comes to Europe, you nailed it. I mean, Italian companies, French companies, those that actually also have a credible hedge and the capacity to be able to move dynamically when needed, when the changing world becomes an issue for their business models. Because when I look at these companies and stories, Steve and Juliana, the problem that I see is that a lot of firms right now haven't gotten the memo that their business models that were geared towards a different world order, a globalized, a hyper-globalized world order, may not necessarily have a credible business model going forwards. Now, I think we are all going to try to borrow our way out of this mess in transition to whatever comes next. I think that's going to be painful for the capital markets. I think it's going to be painful for long end of the curve. So those kind of dynamic companies and families is an asset for any portfolio manager.
What about the fact that the ECB seems to have a lot more leeway than the Fed in terms of its ability to cut rates and in turn support markets? Because as we just saw in the China data again this morning, there's a lot of deflationary pressure coming from China right now, whether that be in the Chinese economy or in Europe, as China looks to divert a lot of the goods destined for the U.S. into Europe.
Look, I think on that disinflation story, you know, we have a print coming out in the U.S. today. We'll see if we get a hot print or not. And I think this time, this kind of data points are more than just prints. This is a litmus test to kind of illustrate whether the disinflation story is credible or not. And I don't think Europe is going to be an exception. ECB may have more of a leeway to cut, but at the same time, Europe will also have to borrow a lot more to support its European rearmament fund, the growth that Europe needs to spur. And look, Europe has had a good time this year, right? Because there was a lot of reallocation of capital from US to Europe because investors were overweight.
It's the country that can afford to borrow more.
They can. They can, because
Yeah.
the debt to
So it's
GDP,
not a problem.
The debt to GDP in Europe is much better on a kind of holistic basis than debt to GDP in the US.
Germans, yeah.
But of course, the thing is, US is the only country that can print this money and spend elsewhere. It has the reserve currency benefit. I don't think that is going anywhere anytime soon. So Europe can afford to borrow. Europe will have to borrow, and ECB can afford to kind of have a different policy compared to the US. My question is, if I'm an investor looking at this completely holistically, where do I allocate? I am still geared towards allocating where innovation will take place, or where thematic sectors like energy security is going to play a more important role, which is where Europe is going to become more prominent.
A lot of the innovation, arguably, is taking place outside of public markets. I mean, when you look at a company like OpenAI, it's, you know, remains private at a $300 billion valuation. How does that feed into your kind of asset allocation view? What role does private markets play?
I think private markets are going to play a more important role going forward. Not every company has to be listed. Not every company needs to get funded through public markets. And I think it becomes an allocator's nightmare ultimately to be able to get the right allocation in these private companies, which is again mostly US bound or China bound. Now, it is going to be a US versus China game at the end of the day, but private markets will play an important role. I do think, though, the global bond markets and capital markets will have to grow in being able to support all of this fiscal stimulus programs that will have to become a reality, plus the tendency for companies to try to borrow going forwards.
Zan, I stand by the view, having spent decades listening to the private equity industry telling me how much dry powder they've got, and in the VC industry telling me how much money they've got to allocate to growth companies, then actually there isn't a problem with good private sector credit or debt finding the right capital. So if indeed now entities such as pension funds, such as private individuals, are now being directed towards private credit and private debt as a way of getting better exposure to younger companies, why are they going to get a good deal when there wasn't a problem with supply of capital to the decent companies anyway? My fear is that there is opacity in those private companies by the nature of the fact they're private rather than publicly listed, and actually the retail investor and the pensions are going into an area where they just don't understand, and it's going to be full of sharks who basically are going to get all the best deals regardless.
I think you're spot on. I don't think it's going to be an easy investment theme, and I think these kind of markets really need to amplify the focus on pricing risk. It's all about being able to price risk, and I do agree there are risks in the market where retail investors in particular may get into the wrong transactions because it's not as easy to due diligence those companies, and therefore you're putting a lot of emphasis and trust on asset managers that are supposed to DD these companies. I don't think
the asset managers who pretty much have all got the same closet index portfolios that I see on the public markets. I've got to trust those people, have I?
Unfortunately, I think you do for the most part. I don't think that's a great business model, by the way. just to kind of, put a line under that. Look, it is in my mind.
Show me 10 growth portfolios and I'll show you the same 7 stocks every single time.
Oh, the Max 7? Yes, you're all kind of heavily skewed towards that. But look, joke aside, yes, Max 7 has its place in a portfolio. I think one of the issues that we have had is that a lot of asset managers feel that they have to double down on that Max 7 portfolio because they can't afford to really cut their exposure. That is a fallacy. At the same time, I think as we see the capital markets, especially at the long end of the curve, looking to reprice, and debts, cost of equity and cost of debt being repriced on its own, a lot of companies across the spectrum, whether they're innovators or they're more traditional companies, are going to have to rethink their business models. There is no easy solution to this. And I think there is going to be a longer term shift and change in allocation of capital across regions, across sovereigns, across companies. And I think it's just the kind of complexity that we're going to have to learn to live with and price. There is no easy solution.
And that's all. That all doesn't even include the impact of AI and how that's going to force the change, force huge changes to business models. Ozan, let me just bring it back to today, the CPI print. You mentioned a hot print. You don't think we're going to get a hot print today. What would a hot print look like? And it feels like, given the delay to tariffs now, we've really pushed out the inflation story. So when could it get hot, if not today?
Well, I think that's why watching PPI is also becoming more important. I mean, PPI in a way is the canary in the coal mine. We need to understand how the supply chain side of it is really going to feel the heat. Then it becomes a matter of how long companies have to pass that inflationary pressures on to consumers. Will it eat into their margins, or will they actually pass it completely through the consumers? PPI is, I think, becoming a more of an important metric, more of a forward-looking metric than CPI. What is a hot print? Anything with a 3 handle is a hot print. I'm not sure if you're going to get it, but it is important that this is the first month where, at least theoretically, we may be able to see the impact of this trade war dynamics. And also, quick 2 words on that trade war dynamics. I think the financial markets have found some order in the chaos that we have learned to try to live with the expectation that this is all done within the perspective of just negotiating. You know, Trump can walk back his fantastic claims about 100% tariff, 50% tariff, but he is trying to get countries to negotiate. What I think is a more structural issue is companies delaying their infrastructure investments and their capex investments, waiting to see what the lay of the land looks like and whether we are going to be operating in this hyper-globalized world going forward or not. I don't think we are, but it's too early to call.
Ozan, you always give us so much to think about. Thank you for coming by the studio. Ozan Azkarol, the founding managing partner at Tanto Capital. In terms of single stocks, we're